Good morning and welcome to this Wednesday, January 26th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, it's a completely different day today. We've got futures way up this morning after a lot of pain the past few weeks to start off January. We got Dow futures up almost 400 points this morning. S&P 500 futures up over 60. NASDAQ futures up 300. And this is what happens when you get a high VIX. You don't know what you're going to wake up to. You don't know if you're going to wake up to the Dow up 400, down 800, up 600. It's really difficult to say. We're going to talk about some of the boundaries. I think, if this is a market that is trending lower, you don't expect to go down 2,000 points on the NASDAQ every 4 weeks. I mean, at some point we're going to get some relief. I think that relief is underway. But we'll talk about some areas where we should be looking for possible reversals back to the downside, or at least areas that could present some problems in the near term. So we're going to get into all of that in just a few minutes. For those of you who are new to Earnings Beats, welcome. I always like to have folks join us. We just, take a look at the market, try to look at it objectively, and see what we think the more likely scenarios are. Obviously, no guarantees, and the market can do whatever it wants. But if you want to learn more about us, start by going over to earningsbeats.com. You can scroll down. We have a free Earnings Beats Digest newsletter. All it takes is a name, email address, no credit card required, completely free. You can hit that subscribe button. We do publish this 3 times a week, Mondays, Wednesdays, and Fridays. It's a quick read, couple paragraphs and a chart usually. And if this is something that after a while, isn't interesting you, maybe you're not a trader, maybe not in the market as much as you were, blah, 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 whatever the reason is, you can unsubscribe at any time, no questions asked. So it is pretty easy. We've got a large community of followers now in the tens of thousands. So this is a very popular newsletter, and it should be. Like I said, it's completely free, no credit card, and we try to give you some pretty good information. Most of it I view to be very educational, things I've learned over the years, the way we approach the stock market, the way we trade, focusing on relative strength, earnings, candlesticks, gaps, those types of things. So if you're interested, go over to earningsbeats.com, scroll down, and make sure you sign up. One last thing, too, is whenever we do free events, and we do a lot of them during the year, when we do free events, we do reach out to anyone who is on this newsletter. So you'll get room instructions. You can come into the events. That's another reason to make sure that you're on this list. All right, let's move on to the market, because it wasn't quite as wild yesterday. The big part of yesterday was the gap down. And once we weathered that, market kind of settled down, and then we saw a rally into the close, which was nice. The Dow Jones Industrial Average did finish down 66. The S&P 500 down 54. The NASDAQ down 316. You might be saying, well, where's that rally you were talking about? Well, we did gap down. We rallied right up until about the last 15 minutes, and then we saw the market pull back again into the close. Mid caps down about 1.75%. Small caps down a little over 1%. So on a relative basis, the NASDAQ was hit the hardest yesterday, down about 2.25%. Energy was the big leader and the big winner yesterday, up almost 4%. Crude oil prices jumped again, and as a result, energy prices did very well. This is the one I talked about, I don't know, maybe it was yesterday, the day before. On the pullback on energy, unlike all the other sectors, as you can see, energy actually is trending higher, and that pullback was just a normal 20-day test. So bounce off of that 20-day was not unexpected there. I think energy still looks pretty good here technically. I would say it looks the best, along with maybe consumer staples. Financials, after falling back, threatening to break below these prior lows, but holding on to support, did see a little bit of a bounce yesterday. We went up about 0.4%. But the laggards were some of the familiar names. The 3 big aggressive sectors, the ones I follow the closest, were the 3 that performed the worst yesterday. So yes, we did have a nice rebound throughout the afternoon, and yeah, we came off the lows and so forth. But technology, communication services, discretionary, all falling. You can see that their AD lines, maybe the discretionary came back pretty nicely the other day on that huge volume reversal. But otherwise, especially communication services, that AD line looking very weak. Technology moving down very swiftly there, as did the consumer discretionary. I just got this feeling like the market wants to go lower, but it's gone like crazy amount already in January. I mean, we're certainly due for a bounce, and I think that's what we're going to get. I think we're going to bounce a little bit here at the open. We'll see what happens with the Fed. If the Fed it remains hawkish, or maybe even increases their hawkish tone, maybe we get an initial reaction to the upside, but I don't think that's going to play out well longer term. When I say longer term, I'm meaning more intermediate term for me, which is over the next couple of months. I think still we've got lows that we've got to go find over the next couple of months. We've got sentiment that we need to build more bearishly, really, for this market to launch later this year and into 2023. So short term, yeah, I mean, we could be anywhere. We could see the gap ups, we could see the gap downs. I think we're going to want to watch some key levels, and we'll talk about that in just a couple minutes. But overall, you can see technology, communication services, discretionary, not very good yesterday. I would expect those areas, with the NASDAQ doing well with futures and all this morning, expect those to do well. But we've had a lot of weakness in terms of the AD line. So I want to see what happens after we gap up. I mean, gap up and gap down, that's just manipulation in my mind. What happens between 9:30 and 4 o'clock? Do we see buying or do we see selling? And do we see the kind of buying that takes us up through key resistance? Or do we see the kind of buying that literally gets folks in to chase just in time for the next shoe to drop? I'm not sure. My guess is, I would just simply be very careful on this move to the upside. And if I was heavily long, I'd be looking to move some of those positions off the table as we do bounce. Inevitably, I mean, we're going to bounce. We're not going to go down every single day for the rest of the year. We're going to bounce, and hopefully this is the start of a decent one now. The 10-year Treasury yield. So economic reports out. First of all, yesterday we had a couple of housing reports out. The Case-Shiller Home Price Index came in a little better than expected, rising 1.2% versus the expected 1.0%. Also, November FHFA House Price Index rose 1.1% versus the estimated 1%. So we got a little bit of good news, but even the good news wasn't great news because that's back in November. These were both November reports. We're getting ready to go into February. That's the one thing that's bad about these housing reports, is many of them are way in the rearview mirror. The market doesn't even care what happened back in November. The market's much more concerned about what's going to happen this November than it is what happened last November. So some of these reports, really just don't pay a whole lot of attention to. January consumer confidence came out yesterday, though, and that was stronger than expected, 113.8 versus 111.9. So I think all of those things helped to contribute to a mild rally yesterday afternoon. I say mild. Normally, I would say it was a pretty strong rally, but when you compare how much we've gone down, it's pretty mild compared to what we've lost. Today, we've got December new home sales coming out in about 50 minutes at 10 a.m. Eastern. November was 744,000. December expected to be 760,000. Again, that's still looking in the rearview mirror. I'm more interested in, building permits, that sort of thing, to see what maybe is coming, rather than the new home sales, which has already happened a couple months ago. But it is economic news. Folks will be looking at it. That comes out at 10 o'clock. And then at 2 o'clock today, that's the big, circle that one on your calendar. That's when the Federal Reserve will be issuing their policy statement. So they are going to be talking about inflation. I will just tell you, I'm not a big fan of this Fed. I'm not a big fan of Jay Powell. I think that they've screwed things up in the past. Go back to the end of 2018 during the trade war, when they turned very hawkish prematurely, and the market basically said, no, that's not what we're going to do. We're not going to raise rates. And the Fed ended up lowering. 6 months later, rather than raising the 2 times they talked about. I don't know what they're going to say this afternoon. I can tell you, though, that when the Fed 1 year is telling me that inflation is transitory and the next year is telling me that it's not, I lose a little faith in them. And I think the market overall is losing faith in the Fed as well. And so I don't know what they're going to say today, but I have a feeling they're going to say what they've been saying the last couple of months, which is that they're seeing these inflationary pressures and they're going to raise rates. And they may even point out that they're going to raise, hopefully they don't come out and raise today. I don't think too many folks are expecting that, but people are expecting that they're going to probably say we're going to raise in March or we're going to raise in May. I don't know what they're going to say. But if they remain hawkish, I think that is playing into the bearish narrative of the market in 2022. And even if they turn dovish, I mean, then the market's going to be like, all right, make up your mind. You were dovish, now then you went hawkish, now you're dovish again. I don't know that they're going to have anything that's going to help the market over the next 2 to 3 months. Are they going to give them something that might help today or the next couple of days? Yeah, just the relief, if nothing else, so that the market isn't fearing the Fed. Once the announcement's out, it's out. Don't have to worry about it again for a while. So I think there'll be potentially a relief rally after the Fed. We've got room to the upside. So we're going to talk about all that. But you look at the 10-year Treasury yield here right now, and this tracks more the mortgage rates than it does what's going on with the Fed. The Fed, it has a Fed funds rate, and that's very, very short term in nature. 10-year Treasury yield's not. 10-year Treasury yield is more long term, so it's more in tune with like mortgage rates and so forth. Still, the 10-year Treasury yield is something that I watch very closely. Because if you're getting into bonds, which sends the yields down, that's money that can't go into the stock market. So when the yields are going up like they are right now, that's money coming out of bonds. It can be good news. Usually it is good news when money is coming out of bonds. And I think eventually it's going to be good news, but I don't think it's good news right now, because I think the money that's coming out of the bonds in the very short term is anticipating the surge in inflation we're going to see over the next couple of months. And we've already had a surge. I'm just saying it's going to go higher. Almost guaranteed. I don't like to guarantee anything, but almost guaranteed we're going to see inflation going up the next 2 or 3 months, the annual core rate. And that's going to spook a lot of folks. There are going to be headlines everywhere. It's going to have the Fed, in the news talking about rates being increased. You're going to have the Goldman Sachs of the world coming out, and telling you how horrible everything is while their market making units are buying everything you're selling. And there's a little sarcasm in there. But anyhow, it is what it is. This is what we're going to have to deal with over the next couple of months, next few months. All right, let's move on to, I want to show you first energy, because energy had a big day yesterday. And, if there's been one thing I have not been right about for the last couple of years, it's been energy. Energy's been in one of the leaders. I have a conversation with Greg Schnell every once in a while, and he's, big into energy. And he writes over at Stock Charts, does a great job. And he follows all the commodities so much closer than I do, and he knows a lot more about them. But he's been on, all over me. He's like, when are you going to get into energy? When are you going to get into energy? And I'm like, well, maybe when the dollar, shows that it's really weakening, that's when I'm interested in energy. On a relative basis, yes, energy's been doing very, very well. And on an absolute basis, you can see it here as well. But if you pull up a 10-year chart, energy is getting back on a relative basis the horrendous performance that it put in for about 9 years. It's just getting some of that back. I don't think energy is done in terms of relative weakness going forward. I just don't know how much in the short term we're going to see out of it to the upside. But I wanted to point out, I still think in the short term, energy looks good. Maybe over the next couple of months, I could see energy possibly getting up to test this 75 level on the XLE. Right now we're at 65. So we still got room to the upside. But I just wanted to point out we are testing 65. This would be a level maybe where we see a little bit of a pullback, just because we haven't had a close until yesterday. We had not had a close over 65 since all the way back in 2014. Think about that for a minute. We're talking almost a little over 7 years going on 8 years since we had seen a close on the XLE above 65. So the good news is we closed above 65. Bad news is probably running into some area up here where there's going to be some resistance, some selling, overhead supply. Now, if we can successfully negotiate 65 and we start printing 66, 67, there's a pretty good chance we're heading up to 75 on this run. Now, maybe it's, stair stepping like this, but I would expect sometime in the first quarter, we have a pretty decent chance of hitting 75 on the XLE. So short-term trades, I'm fine with energy. Just keep your stops in play in the event, this trend line breaks down, or maybe if we go back and fail to hold the 58, 59 level, which is the last breakout area, I just make sure I have my stops in play. That's all. All right. I mentioned a couple of those housing reports yesterday, and then also new home sales coming out later this morning. So I thought I'd bring up the home construction group, where we had a double top. We went down, we broke down below this intermediate bottom between these two tops. That's usually not a good sign. We have already made that measurements usually from the top, which is 1750 down to around 1600, maybe a little below. So that'd be about 160 points from about 1590. That would take us down to 1430. Well, if you notice, just a couple of days ago, we got down to about 1410 before rebounding. So we've made that initial measurement. I think on a chart like this, and really on many of the charts that are broken down, I would be looking at these prior lows. Here's one here. Here was a kind of a kick save hammer right at about the 1540 level. I think housing could get back up to 1540. That's 80 points, we're up 75 points, which would be maybe about 5% or so from here. Notice also that the 20-day EMA, when you're rising in an uptrend, you come down, you test the 20-day EMA, and that generally holds, and you move higher. Then you go through periods of consolidation. Well, here, same thing. Holding the 20-day, go through this period of consolidation, and now we're downtrending. We've already moved up once and failed at the 20-day moving average. So keep in mind, right here is the 20-day. So you got price resistance 1540. You got the 20-day dropping at about 1560 and change right now. So as you get up over the next day, 2 days, 3 days, whatever, however long this rally lasts, not just in home construction, but in a lot of the areas of the market, when you see prices moving back up close to where they broke down from, and you get closer and closer to 20-day EMAs, if you're somebody who wants to short, I'm not a huge fan of shorting because I do still believe the big picture, the long-term secular bull market is in play. This is no different. Any pullback that I'm talking about in 2022 is no different than the pandemic. It's no different than the trade war. It's no different than 2015, 2016, when we went sideways for a while. That was all part of a secular bull market. You can go through periods of not good action during a secular bull market. The market doesn't have to go up all the time. So that's kind of what I'm looking. I'm looking for really, cloudy weather, murky waters for the next 6 months, maybe. And then I think we come out of this breaking out to new all-time highs. So I'm just trying to protect capital between now and the middle of the year, maybe even into the fourth quarter, because I do think later in the year, we are going to have a massive rally. And I think it's going to be when the Fed realizes, or when the stock market realizes that, you know what, we still got really good growth and we don't need to raise rates, and inflation's not a problem, because all those factors which are killing growth stocks right now, when that switch turns, all these stocks are going to go up just as fast as they're going down. Maybe not quite as fast as they're going down. They're going down really fast, but they're going to be trending higher again. My opinion, just my opinion. So anyway, that's, something that I'd be looking for here in the short term. If you're really an aggressive trader and you want to do longs, you want to do shorts, you want to try and play it back and forth. We had the VIX hit 39 2 days ago, back on Monday. That's when I sent the email out to everyone, 10:15, 10:30 in the morning, and said, look, you don't see a VIX at 39 very often. Maybe it goes to 45. Rarely does it go above 50. I mean, when you start getting up close to 40, that's normally when the fear has reached a level where the market, it's almost like a rubber band. You've pulled it back about as far as you can pull it without it snapping. And when you let go, it's going to come roaring back. And that's usually what the market does when you get the VIX at 38, 39. So short term, I'm not surprised we're seeing futures where they are. I'm not surprised we had that huge rally on Monday. You know, I'm not surprised yesterday afternoon we were rallying into the close. I'm also not surprised that in the last 15 minutes we gave a lot of it back, because when you get a VIX up in the 20s and 30s, you get whipsaw action. You think you see something and it's a mirage, and next thing you know, it's going the other direction, which is why I tend to just kind of watch things, pick a spot here or there on a trade. If I make money, great. If I don't, I try to get out fairly quickly without, you know, losing the house, that type of thing. You know, we're probably going to rally, and we're going to see what this rally is made of as we move up to some of these key areas. So let's talk about the S&P. What are the key areas on the S&P? Well, I already pointed out to our members and written an article. This to me is looks like a neckline to me, coming across here at 4,300. So I think 4,300 on the S&P on a closing basis looks pretty good. Intraday on Monday, you know, when we had that crazy, you know, waterfall of selling that took place early in the morning, took us down to 4,200 and change. We came right back and we held on to this prior low on a closing basis. And this, by the way, is why I follow closing prices and not intraday. Intraday, we had the breakdown. I mean, you'd have been shorting, right? Well, the problem is market makers, if you understand the role of the market maker, if they want to buy stocks, the best time to buy a stock for a market maker is when you get a breakdown, because everybody else has stops in. They're all getting their stops triggered. And so if market makers truly want to acquire stocks, all it takes is a breakdown. And so that's where you get those big reversals. So now, after you get the big reversal, who's buying at 4,200 when the market is panicking? Usually it's the market makers. That's how you get the reversal. And if they're buying and they're on the long side, that's usually when you have a little bit of a bounce so that they can make their money. You know, we always want to make sure the market makers are taken care of. A lot of sarcasm in that statement. Anyhow, let's keep going. I want to show you on a annotated basis. This was a low right here. That was prior support. I mean, we moved down at the beginning of December on some pretty good volume. That was decent support. Then you also had this other low right here. You know, 45.60 or so, and then another one 4,500. So that was support on the way down. Well, when you got a high VIX, this is what I talk about. When you get a high VIX, support, just throw it out. You know, we don't even care about support. It's all about sentiment. When you start seeing those big panic moves to the downside, did we turn at 4,300? No. I mean, we kept going right through it. We didn't turn at 4,500. We didn't turn at 45.60. You know, we didn't turn up here at 46.50. I mean, when the VIX is picking up speed, it's like the market, the sellers will squash anything in its way. Doesn't matter what the support level is. The way you mark bottoms in panic is with the VIX or with maybe the equity only put call ratio. It's all about sentiment, because that's what's driving the market lower to begin with. It's the fear, it's the panic. It's not program selling, you know, tactical selling. It has nothing to do with that. It's fear. So when fear is ruling the roost, you've got to look to fear indicators to find a bottom. All right, so 4,300 kind of establishes a neckline. So up in this area, I mean, if you look at this, this could be a left shoulder, which also, by the way, is in this 4,500 to 4,560 area. Then you've got the neckline. You've got this double top in here for the head. Come back down, right side of the neckline. A bounce here above 4,500 starts to get scary to me from a long perspective, just based on what I'm seeing here on the chart. Now, normally, I would say we're in a secular bull market, and I'm not looking for topping patterns. You've probably heard me say that many times. Normally, that's what I would say. However, let's rewind and go back to some of the issues I've been talking about in the market. These are not short-term issues. Sentiment and where it's been for the last 2 years. I mean, notice, I'm going to show you one other chart here. This is the S&P 500, and then the equity only put call ratio down here at the bottom. Let me pull this up for you. So, I mean, as we've been moving up here last couple of years, notice the equity only put call ratio, the 5-day moving average is mostly between 0.4 and 0.6, almost always. It wasn't like that before. It used to be much higher. It used to be like 0.55 to 0.80 was kind of the range. So we've gotten so bullish longer term. And now look at what just happened. We just moved out of this range for the first time in almost 2 years. And I think we're resetting sentiment right now. But when you look at this, you say, well, yep, we're definitely resetting sentiment. I want you to take a look at what happened the last 2 days. We got a little bit of a rally on Tuesday, and then the big rally on Monday, and a little bit of a rally yesterday. We went from 0.82 on the put call ratio from back last week to the first 2 days of this week, 0.675, and yesterday was 0.61. We're coming right back down. I don't think this rally is going to last. I think we're falling into the same trap. So what, I spent a lot of time on this, but I think going into the next few days to few weeks, I look out at some of the news that's out there as well. And of course, once we get by the Fed, I think that'll be good for the market. But then you roll into February and we've got the PPI and the CPI coming out, I guess it's the first, maybe second week of February. I have to go and look at those dates. But I think we could be okay. But I think the market is probably going to start bracing again at some point between now and then for what is likely to be another jump in the core CPI. So I don't know what to say about this market except just be careful. I think this is a treacherous market. Yes, everything looks really good right, today, and the Fed might meet, and, we might have a big rally. We might see the Dow up 800 today, and then we got Tesla reporting. What if Tesla says, great quarter, but, we see a slowdown ahead, or we don't know what the, inflation, who knows? All they have to do is issue something that sounds like a little bit of a warning, and we could see those futures erase all the gains if we have big gains today. I'm not saying it's going to happen. I'm just telling you that these are things that can happen when the volatility is at where it is right now. So we've got to be ready for it. All right, as far as some of the earnings that came out, let's move into the earnings spotlight just for a minute. And we'll wrap up with the three you must see with a few of these earnings reports as well. But let's take a look first at Microsoft. That was probably, that was definitely the biggest news yesterday. They beat on their top line. They beat on their bottom line. I thought their guidance was pretty strong. You see the stock up a nice 6% this morning from 288 to 305 after this huge drop. Just remember, 305 is where the drop began. The 20-day EMA right now is about 311. So, maybe we gap up. Maybe we have a big move. Maybe we get to 315 intraday, 320. But be careful. After the Fed, maybe the bottom falls out. I don't know. I just know that there's probably going to be a lot of things that we're not expecting. And it's going to be wild. It'll be volatile. If you happen to nail it just right on the long side and on the short side, you can, just back up your Brinks truck. If your timing's wrong, if you're chasing at the wrong times, it can get really painful and you get to a point where you don't want to trade anymore. So what I would just do is if you feel compelled to trade, unless you're really a gambler, if you feel compelled to trade, I would trade probably no more than half of the normal shares that I would trade, maybe a third. When I trade, sometimes in this kind of a market, I'll go to the ETFs as opposed to the individual stocks, unless like the other day, we saw the VIX get to 39. I had a couple of long stocks. I also did an ETF as well. But for me, it was about, how much lower could we go? I had to take a little bit of a chance. We're not at that point now. Now we've come off of that level. Now we could go either way, and it could be very swift. So just, to try to cut down on the emotional trading, because if you start trading emotionally, you're done. I mean, once the market makers get you in that corner, you can't think straight. You're just trying to get your money back. It's not a good place to be. So for me, again, I feel so much better being mostly in cash and then just picking my spots here or there for a trade until we get to an extreme, one extreme or the other. Now, again, you get up to the 20 days, you start testing 20 days, moving through intraday. That's the point. If you wanted to short, it's not going to feel right because the market's going to be going crazy. You're going to think, oh my gosh, this is great. Let's jump in on the long side. Well, it's probably the better time to be on the short side at that point. Anyway, it's going to be a wild couple of days coming up. Texas Instruments reported. This is one I actually liked going into earnings. I didn't do anything with it personally. Now the market just opened. You can see Texas Instruments back up to the 20-day, and that's where it broke down from recently. So it'll be interesting to see whether Texas Instruments can continue to move higher from here. F5, not so lucky. F5, and they beat 289 versus 279. I saw the numbers come out. I'm like, wow, this is not too bad. Let's go over to the charts here. Look at F5, gap down to 195. Now, everybody's selling at the open. Market makers are on the long side. A lot of times you'll get this rebound and right back up we go. I would just be careful if we get anywhere back up close to that 215, 220 area. It's probably could just be market makers making their money, and then you roll back over again. Let's get a quick look again at Microsoft, and I'll give you 3 more stocks for the 3 you must see. There's Microsoft up close to that 20-day. We'll see whether or not we can get through. Next Gen was one I think that we had looked at our earnings webinar the other day. Let me pull it up on a relative chart and see. Yeah, this is one I think that was moving up relative. I know I saw it. I don't know if I've mentioned it in the talk about so many stocks. I just can't keep track of them all. But this is one that had been moving up relative to software like Microsoft. And we actually got a positive reaction at the open today. They did beat 24 cents versus 21. So I thought Next Gen looked pretty good. LRN, this is a smaller company, Stride Inc. They absolutely crushed. They were expected to earn 77 cents. They came in with $1, and the stock had been beaten up really badly. Didn't look very good on a relative basis, but so far today, big move up, trying to change the character on its chart. Anybody looking to short a stock like this, anything up around 38, 37, 37 and a half. And if it closes over 38, get out. But this would be an area where I wouldn't be surprised to see a pullback. And then the last one, maybe for the 3 you must see, let's look at, how about HES? This is in the oil space. They beat 85 cents versus 76 cents. And this has been a very strong area of the market. It gapped up. It actually gapped up above the prior candle body right here, which was 94.29. And it opened today at 94.50. So it's pulling back, but this is one that I might consider being aggressive on the long side. If it gets back to that 20-day moving average, maybe taking a chance, small position. And then, because the fact that it gapped up above tells me that it might go back and return to that level later today. But a lot of times everybody's chasing it at the open. So the market makers are on the short side. You pull back, sometimes hit a key support level, and then you'll see a big bounce. So I think Hess, as it gets closer and closer to that 20-day moving average, would be an interesting potential trade. Now, again, it's the day of earnings. It's going to be volatile. If you're somebody who's more conservative, this is not the kind of trade. I would look more at like the earnings beats digest chart I gave today, which is Church and Dwight. That's a more defensive stock. It's probably not going to have a huge move. Oh, actually got down to the 50-day, which is what I was hoping for. I wish I'd been looking at this one and been in my account. I might have bought it at the open. Anyhow, this is the one had a negative divergence. So I was thinking any kind of a move back to around 97.5 would be a great entry point. Unfortunately, it hit 97.65, but anyway, it's already rebounded up a couple bucks. But this is the type of stock, if I was more conservative, I would be using weakness to get into some of these like consumer staples stocks. Wouldn't be expecting huge moves in either direction, but this is where the money has been rotating toward over the last couple of months. So if the market remains weak, I think you'll get an outperformer with CHD. I don't know if you'll make money, but I do expect it to outperform the S&P 500. All right, that's it. Let's see what the market's doing, see how much it is up. All right, Dow up 223, NASDAQ up 292. So maybe we're pulling back a little bit from earlier, at least from where the futures were. Fed coming out at 2 o'clock today. I cannot stress enough with a VIX that's up near 30. We could be anywhere today. I mean, I'd like to tell you that at the end of the day, we're going to be up another 300 points on the NASDAQ, and maybe we will. But we also might be in the red after the Fed. I have no idea. I honestly have no idea. I have these boundaries I'm looking at for a right shoulder on the S&P 500, maybe up around 4,500 to 4,550. So we got room to the upside, but then we got the neckline down at 4,300. So I'm just watching these key areas, big picture, and anything in between goes with the VIX where it is right now. So just because you see the market trending up for a period of time doesn't necessarily mean it's going to continue. Just keep that in mind. All right, that's it for me. I'll be back tomorrow for a recorded version of Trading Places Live. You can find that over at Stock Charts TV at 9 a.m. Eastern on Thursday. So go over to Stock Charts TV, tune in, and you'll get the recorded version, which will be after today's close, by the way. So I'll be summarizing the action today. So if you want to see what I'm thinking after another 24 hours of madness, go over to Stock Charts TV and check that out. All right, listen, everybody have a great day. Be careful out there. Happy trading.